Hi, in this video I'll be sharing with you how you can trade divergence using the CCI and how profitable this strategy is. I'll be showing you exactly how you can combine the divergence strategy in line with the trend of the market, how you can identify this divergence, and how exactly you can execute your trade using the divergence trading strategy. If you are coming across this video for the first time, please do well to give this video a like, share, subscribe, turn on your notification bell so you'll be the first to get notified when we upload our next video. If you're looking at my chart, this is GBP USD. Before then, let me show you the setup of the CCI. First, we have our relative strength index, and this is the level of the relative strength index. And then afterwards, we have our commodity channel index, which the period is 14. Then we have our Bollinger Band on our main chart. The period is 130, deviation is 2.0. We have our moving averages, period 25, shift is 0. Then we have the last but not the least is the moving average, period 10. Now, when you are done with your setup, your chart will be looking exactly like mine. Many times as a trader, we face the challenge of entry. Price always tend to hit our stop loss, and that has been a challenge. I've been there before and I know exactly how we feel when after execution or after analysis, trade hits our stop loss. So in this video, I'll be showing you how you can take advantage of the commodity channel index divergence in order for you to make your trade entry. Remember, it has been established always that the trend is your friend. So the first thing we'll be doing is for us to determine what is the trend of the market. And looking at this, obviously, you will agree with me that this price is in a downtrend. So you can see the price is moving towards the downside, and this is a typical downtrend scenario. So having established that we are in a downtrend, the next thing you need to do is for you to watch out for your divergence pattern. Now, this divergence formed at any zone provided on this downtrend, you'll be looking for opportunity to sell. But there are more advantage to it if they are found in a particular zone. And what is the zone? These zones can be your structural point or close to your trend line. So for instance, when we look at this, price came down here, left here to this upside, came down again. So we can obviously establish that this point is a lower low and this point is a lower high. Then we have a new lower low. So which means that we can, based on this structural point, which is here, we can mark that zone as our order block. So if we are to have our order block, this is our order block as far as this zone is concerned. Now, having marked this order block, how do we bring into play the divergence? So when you have marked this order block and this coincides with our trend line, what we want to see price pull back because it's a downtrend, so that we can find an opportunity to sell to the downside. And this is exactly what happened. So looking, price pull back all the way from here and price pull back into the order block. So when price get into this order block, what do you see? Look at this now. This is making a high. This candle movement is making a higher high. But let's look at our indicator window. This is a lower high. This is a lower high. So you realize that here price is high, and here the moving average, the commodity channel index is high as well. But look at here now, price becomes higher than the previous one, right? But look at our commodity channel index, it becomes lower than the previous high. If price is high, the ideal scenario is that this commodity channel index too should be higher. But in this case, the commodity channel index was doing opposite of what the main chart is doing. So here we can now bring up our trend line and connect these two highs together. So this disagreement between the indicator and our commodity channel index, this disagreement is what we refer to as divergence. And immediately we spot this divergence, what was the next thing that happened? You can see the reversal of price from that zone, and that is how price begins to drop, right? So you can see price. So when you can move to your 15-minute time frame as well to find this entry beautifully well. This is our 15-minute time frame when price gets to this zone. So how do we do this? Look at this. So you have this series of rejection of candlestick formation. You can see that bearish pin bar there. Then this would have been your entry, and you would have sold all the way to this down point. So this strategy is very much simple, and it is easy to understand. Simple and easy to understand. So this works often, but however, do not apply this against the trend of the market. In other words, it is best profitable when it is being taken as a continuation pattern, as a pullback, and not against the trend of the market. So that is what I am trying to establish in essence. Do not trade it against the trend. It is not against the trend. It won't work that way. If we look at our H4, this is crash 500, and of course crash 500 has been bullish. As we can see here, we have a break of structure to the upside. So this price scenario has been bullish. So on our 1 hour, we had this trade pullback, and in this pullback, if you are looking, they have mastered how to identify this pattern. Here now, this is a typical divergence. Now you need to backtest, train your eyes to be able to identify how these patterns are actually formed. So here is a divergence scenario. So this is a bullish entry. So I will be taking a buy trade. So I just confirm my entry, and my stop loss is going to be at this low. So what I see a pullback, because this is an uptrend, and in this pullback it pulls into the 4-hour order block. Then I have to go long. So here I am on this trade with my stop loss set, and this is exactly how you can take advantage of this strategy and see how effective the strategy is. So this works even on our 15-minute time frame. You can see that the divergence is obvious. Do you see that? This is the divergence we are talking about. and you can take advantage of this anytime in the market. So this is how perfect it is, and then you see it, provided it's in line with the trend, it works. It will only drag you when you are doing it contrary. Let me show you an example of what I'm saying. Now this is crash 1000. Crash 1000 is in an uptrend. So let's assume what is happening now should be more like a divergence. Indicator is going down, price is going up. So you are expecting that, oh, let me sell. No, it doesn't work that way. It must be, in as much as this is in line with the trend, I can assure you it is 80 to 90% accurate. So what you should be looking for is for price to pull back on its own accord. Then look for a divergence for you to buy. Let it be a divergence in a buying form, not to sell, not to counter the trend of the market. If you try this against the trend of the market, honestly, you will be disappointed. But when it is in line with the price, it works perfectly well. Like in this scenario, this is a trend continuation, this is divergence. Now here we're having equal low. So even this equal low is a divergence because price was not doing equal signal. Price was doing lower low, but we are having equal low on our indicator. And from there, you can see how this pin bar was formed and price began to push to the upside. And I believe you find this video helpful. I believe you have learned something new. Backtest this, and please do well to like, share, comment, turn on your notification bell so you'll be the first to get notified when we upload our next video. And also there is a link in the description of this video that will lead you to our Telegram group where you can join our mentorship class and as well as get a free signal that will help you improve on your trading journey. Thank you so much and see you in the subsequent video.